Assalamu alaikum wa rahmatullah. In the name of Allah, the most gracious, the most merciful, praise be to Allah, and peace be upon His Prophet Muhammad, for friends and followers until the day of judgment. Inshallah, today we are continue on financial statement analysis, and particularly this lecture we will deal with ratios statement analysis. I told you before, and you know that there are three tools of financial statement analysis. These are horizontal analysis, vertical analysis, and the ratio analysis. Horizontal analysis, as I stated before, evaluates a series of financial statement data over a period of time, and I think we know it, inshallah. Vertical analysis evaluates financial statement data by expressing each item in a financial statement as a percent of a base amount. Then today is the third tools, ratio analysis. Ratio statement analysis. Ratio analysis expresses the relationship among selected items of financial statement data. Again, ratio analysis. A ratio expresses the mathematical relationship between one quantity and another. A ratio expresses the mathematical relationship between one quantity and another. The relationship is expressed in terms of either percentage, 100%, 200%, 105%, etc., a rate, 2 times, 3 times, 1.5 times, or a simple proportion, 2 to 1, 3 to 1, 4 to 3, and so on. Ratios can provide clues to underlying conditions that may not be apparent from individual financial statement components. The ratio is more meaningful when compared to the same ratio in either periods or in competitors' ratios or industry ratios. This is very important. The ratios can provide clues to underlying condition that may not be apparent from individual financial statement components. And the ratio is more meaningful when compared to the same ratio in either periods or to competitors' ratios or to industry ratio. We have 3 types of ratio. We have liquidity ratio, profitability ratios, and solvency ratios. And actually we need all these types of ratio because the needs of the users is different. The needs of the users are different, so we do need to the all types of these ratios. Because some interested in profitability, and some interested in solvency, and some interested in liquidity. Each user is looking for a type of ratio to be sure that what he wants actually. So the three types are needed. Liquidity ratios measures the short-term ability of the enterprise to pay its maturing obligations and to meet unexpected needs for cash. Again, liquidity ratios measure the short-term ability of the enterprise to pay its maturing obligations and to meet unexpected needs for cash. Profitability ratios measure the income or operating success of the company for a given period of time. Solvency ratios measures the ability of the company to survive over a long period of time. So these are the three types of ratio analysis. Some ratios for liquidity, some for profitability, for measures of profitability, and some measures the solvency. These are the three types, and what are they mean? Then we can start with the first one, liquidity ratios. In the liquidity ratios, we have four types of ratios to measure liquidity. The first one is current ratio. Current ratio can be found by current assets over current liabilities. This ratio measures short-term debt paying ability. Short-term debt paying ability. This one is important for the short-term debt paying ability, and I'll just remind you with what is meant by current asset. Current asset is cash, and an item can be converted into cash within 1 year. And the current liabilities, its obligation should be paid within 1 year. This is the current ratio. We have another ratio, we call it asset test or quick ratio. This also measures immediate short-term liquidity. Immediate short-term liquidity. This one a little bit different from the current ratio because it uses the current asset except inventory, because inventory sometimes or most of the time is difficult to be converted into cash within 1 year. This is why we use the asset test or quick ratio. It includes cash plus short-term investments plus receivables net. Receivables net, it means the receivables minus any reserve or any allowance for doubtful accounts. We use allowance for doubtful accounts, so we deduct the allowance from receivables. It gives us the net, so we use the net. Then cash plus short-term investments plus receivables net over current liabilities. It gives us immediate short liquidity. Then the third one is receivables turnover. Receivables turnover, as you know, receivables has a direct relation with credit sales. It has no relation with cash sales, but it has a direct relation with credit sales. So we use net credit sales over average net receivables. I explained net receivables and average, as I mentioned before. It means the receivables at the beginning of the period plus receivables at the end of the period over 2. This is the average. And the net credit sales, it means we have two types of sales: cash sales and the credit sales. Then in this case we exclude we deduct the cash sales from sales, or we sales minus cash sales, it gives you the net credit sales. This ratio, receivable turnover, measures the liquidity of receivables. It is measures liquidity of receivables. I'll give you example, and I'll give you how to explain it, or how to express it when you have a ratio, and it's a ratio when it's better to decrease or increase. Then the third one is inventory turnover. Inventory turnover, this one we find it by dividing cost of goods sold over average inventory. And the average inventory, it means again inventory at the beginning of the period plus inventory at the end of the period. This average inventory, and it measures the purpose of this one, or this one we can use it to measure liquidity of inventory. To measure liquidity of inventory. These are the 4 types of liquidity ratios, and I'll comment on them after we finish the other ratio, inshallah. Then we have another types of ratios. This is profitability ratios. This one is profitability ratios. We have 7 types of it. The first one is profit margin. Profit margin, and this one is very known to us. Net income over net sales. Net income over net sales. This one measures income generated by each dollar of sales. This formula This ratio measures net income generated by each dollar of sales. The other one, asset turnover. Asset turnover, and this is net sales over average asset. And again, I'll remind you with average. Average, it means assets at the beginning plus asset at the end of the period over or divided by 2. It gives me the average asset. Then we have net sales over average asset. This ratio measures how efficiently assets are used to generate sales. How efficiently assets are used to generate sales. The third one, return on asset. Return on assets. This one, return on asset, net income over average assets. You know the difference between assets turnover and the return on asset. In the last one we use net sales over average asset, but this time we use net income. Net income over average asset. And I think you are able to compute the average. As I told you, this is the first and the second over 2, and this one measures overall profitability of assets. This ratio, return on assets, measures overall profitability of assets. The fourth one, return on common stockholders' equity. And this one, I explained it in the last chapter when we make financial analysis for income statement. This net income over average common stockholders' equity. Average common stockholders' equity. It gives me a return on common stockholders' equity. And as I told you in the last chapter, we can compare we use this one to compare between other financial financial statement. This one measures profitability of owners' investment. This ratio, return on common stockholders' equity, measures profitability of owners' investment. The fifth one, earnings per share, EPS, and the EPS is used for the corporation, and I explained it last chapter. This is net income for the common stockholders divided by weighted average common stock outstanding shares. Common shares outstanding. And this measures net income earned of each share of common stock, EPS. Then price earning ratio. Price earning ratio. This is the only one we use the market price, and the market price we can get it from the newspaper, from the TV, from stock exchange. We can know the market price. Market price for share of stock over EPS or earning per share. And this one, it expresses more because it gives us, we can use it to make alternative investment. or to continue in this company. This one measures the ratio of the market price per share to earnings per share. The ratio of the market price per share, earnings per share. The last one in the profitability ratios, payout ratio. Payout ratio, this is cash dividends over net income. And this one measures the percentage of earnings distributed in the form of cash dividends. So it measures the cash dividends, as you see, compared with the net income. And actually this one we can differentiate between the successful companies and the others, because the successful companies always reinvest their retained earnings or their net income to reinvestment, to expansion in the company. So they distribute a little bit of cash dividends, so it will be less payout ratio. This is the 7 ratios which measures profitability. Also, I'll give some comment on some of these ratios after we finish the third type of ratios. The third type of ratios, solvency ratios. We have 2 ratios. The first one is debt to total assets ratio. Total debt, and all of you know what's meant by total debt. Current and long-term liabilities over total assets. This one measures the percentage of total assets provided by the creditors. Because the assets, as you know, either provided by the investors or the creditors. So this one measures the percentage of total assets provided by creditors. The last one and the second one in solvency ratios, times interest earned. Times interest earned. This one measures the ability to meet interest payments as they come due. Again, this ratio times interest earned measures ability to meet interest payments as they come due. And the formula for it is income before income taxes and interest expense over interest expense. Net income, again, net income before income taxes and interest expense over interest expense. And this again measures the ability to meet interest payments as they come due. So, as I mentioned before, we can use each type for different purposes. As we studied, we have each one can use for a certain purpose. So we need the most of the ratios to evaluate the company. And I'll give you some comment you can use when you use this ratio, because single ratio by itself may not be very meaningful and is best to interpret it by comparison with past ratios of the same company, ratios of other companies, or industry norms, or predetermined standards. In addition, other ratios of the enterprise are necessary to determine overall financial well-being. So, if we have some ratios, we can make a comment of them, and it is better to decrease or increase. Before we do this, we can mention that these ratios, as I said, is used by different users. So, a short-term creditors, such as bank, is interested in the company's liquidity or ability to pay obligations as they become due. Okay? And on the other hand, the liquidity of borrower is extremely important. The liquidity of borrower is extremely important in evaluating the safety of a loan. A long-term creditor, such as bondholder, would be interested in solvency. I mean, the company's ability to survive over a long period of time. Then a longer-term creditor would also be interested in profitability. They are interested in the likelihood that the company will survive over the life of the debt and be able to meet interest payments. On the other hand, stockholders are also interested in profitability and the solvency of the company. They want to assess the likelihood of dividends and the growth potential of the stock, and so on. These ratios are used by different users, and each kind of user needs a certain time of evaluation. He wants to know it. The time interest earned which is an indication of the company's ability to meet interest payments, and the debt to asset ratio, which indicates the company ability to withstand the basis without impairing the interest of creditors. Also, the current ratio and the asset test ratio, which indicates company's liquidity and the short-term debt paying ability. The earnings per share and the return on common stockholders' equity, both of which indicates the earning power of the investment. So, it is different different. They are different ratios for different purposes. Each one has a special purpose or a certain purpose can use in it. We can also mention that some ratios could be increased. It is in favor of the company, and some ratios could be decreased. It would be in the favor of the company, and so on. So the increase in profit margin is good because it means that the greater percentage of net sales is going toward income. Also, the payout ratio is cash dividends divided by the net income. In a growth company, the payout ratio is often low because the company is reinvesting earnings in the business. The price earnings ratio, call it PE, the initial PE, is a reflection of investors' assessments of a company future earnings. Investors favor the high price, the high percentage, because the investors feel that to be able to generate even higher future earnings, and the investors are willing to pay more for the stock. The increase in the debt to assets ratio is bad because it means that the company has increased the obligations to creditors and has lowered its equity. The decrease in the times interest earned is bad because it means that the company's ability to meet interest payments as they come due has weakened, and so on. So this is the some comment on this ratio, and inshallah when we have some exercise we have more comments on it. I hope you will study this one very good, because this one needs more effort from you, because it is different from one ratio to another. Okay, thanks very much, inshallah, and this is the end of this chapter and the end of this course, and inshallah we will solve some problems in this chapter and the other chapters inshallah. Thank you very much. Assalamu alaikum wa rahmatullah.